You've obviously run the projections around spending, taxation promises, the implications for debt and deficit in Australia. So what would this potentially mean for Australia's credit rating?
Yeah, so the Australian credit rating is AAA with a stable outlook, so we are not expecting to change it. What we've highlighted, though, is that we are moving to a deficit of, say, 2 to 2.5%. This was before the election. This is also before the trade tensions with the US and China and the rest of the world, as well as global growth slowing. So before factoring in those things, we expected the deficit to kind of widen to around 2 to 2.5%. That's consistent with the AAA. The question we're raising in yesterday's note was, what happens if it goes to 4%? How are governments going to actually fund this extra spending? To 4%, we will see indebtedness in the entire society rise, and that's not consistent with the AAA.
Of course, how much of this can we say is electioneering? I mean, a lot of what's being said now, can it really be expected to survive political and economic reality once all this dust settles, particularly if there's a minority government and policy timidity?
Yeah, and we did note that as well, is that all policies are subject to parliamentary discussions and negotiations. Nothing is final yet. We're not going to act on something which is preliminary. We want to see what the government, whoever is elected on Saturday, is going to deliver. And that has to go through negotiations through the Senate as well as Parliament.
In a more fundamental issue for Australia, given the broader global economy and how China is performing, what are the fundamental changes that could happen from the Australian economy, which has really benefited from China's ascent in the last few decades?
Yeah, and that's a crucial topic. So we have seen spending at record highs. So government spending is at 27% of GDP. It traditionally has been around 20%, so a huge increase in spending since 2020. That has been funded by commodity demand, particularly iron ore from China. The question going forward is that kind of windfall is kind of unwinding. The revenue growth is not going to be there to fund this revenue, this expense. So where's the government going to find the extra money? Are they going to cut back on spending? Are they going to find new revenue streams? What we do know is that there's a lot of volatility in the markets at the moment. We're not exactly sure what that means to the Australian economic outlook. Our initial take back in April the 2nd, when the initial tariffs were announced, was that there would be a 0.2% hit to Australia's annual growth year on year. So we would see growth coming in the high ones instead of the mid to low twos. So that was the initial take. We haven't updated it since, given that tariff policies have been changing rapidly. But we are seeing that this will be a drag on Australia's economic and revenue growth.
But it does tell you about flows. We are now
How strong tools do Australian policymakers still have in the toolbox in order to really try to shore up the economy, especially when it comes to the central bank and potential more easing in order to support growth?
Yeah, we have just started entering the easing cycle. We do expect more rate cuts to come later this year, maybe another one, if not two. So that is something the central bank can do. We're not expecting them to go back into QE type of mode. The Australian government itself has a lot of fiscal flexibility on its balance sheet. It still has room to spend at the AAA level. Obviously, AAA is only one notch of a credit rating. If we were to lower that rating to AA+, which we're not thinking at the moment, but that would give a significant amount of room on the fiscal side for the government to spend. So there is plenty of room here if the government needs to open up its books and spend more money if it chooses to do so.
Yeah, how resilient do you see the Australian economy in this not only uncertain trade environment, but also with demand from China for raw materials exports starting to, well, it's not quite what it used to be, is it?
Yes, as we highlighted, the reliance on China has been very high for a number of years now, going back decades. China stimulated its economy post-GFC. That was a great benefit to Australia. We've seen other tensions when it comes to gas supply and oil supply, which has helped Queensland with its LNG exports and coal exports. So China, its health is actually quite important to the Australian economy. We are expecting China to be hit quite hard with some of these tariff issues at the moment. We are expecting growth to slow. We don't know that exact number yet until we figure out what the final tariff policies are. But anything that China does when it comes to stimulating the economy will be very beneficial to Australia. We're not seeing a lot of stimulation from the Chinese government yet when it comes to infrastructure side of spending. So that will actually have an impact on iron ore demand, commodity demand, Australia's terms of trade. And this is not good signs for Australia's growth projections going forward.
When do you see the Australian budget returning to surplus? Because we did have a couple of surprise surpluses, but as you note in your report, it seems to be deficits for as far as the eye can see, and certainly Treasury projections reflect that as well. What would it take to get the books back into the black without any potential hit to growth?
Yeah, there would have to be a big pullback in spending at the moment because we just can't see the revenue growth being there. We can't see iron ore prices being at $200 a tonne. We can't see record coal prices at the moment. Inflation, while it's bad for households, is actually really good for government budgets. It's really driven higher income taxes, for example, higher GST receipts. As inflation slows, wage growth might slow. These are all revenue headwinds, so we don't see the government returning to surplus. We don't think they need to get to a AAA rating. A modest deficit of, say, 2% of GDP is consistent with a AAA rating. That's where we're headed at the moment. So we don't see surpluses on the horizon unless there's a major revenue boost, which, again, we can't see that.